Hey everyone, this is You Mon from ChurnZero. We'll get started in about 30 seconds. So come on board, get yourself comfortable, get some coffee. I think you'll need caffeine to keep up with Dave and myself for the next hour. We're really going to go at it. So we'll start in about 30 seconds. By the way, welcome, Dave.
Thank you. Great to be here.
Yeah. So we'll give people time to get on, and then we have a good hour of talking about metrics. I think you and I should talk about metrics for 4 hours someday and see if we can actually do it.
The metrics marathon, we could do that.
Metrics marathon. My wife will kill me if I ever went on a metrics marathon. All right. Let's just give people a few more seconds. How do I sound, Dave?
You sound great.
Okay, you do as well. All right. Okay, well, hey, let's get started. Well, good afternoon, and thank you for joining us today. I'm You Mon Tsang. I'm the CEO and co-founder of ChurnZero, and I want to welcome you to our webinar. It's titled A Crash Course in Customer Success and SaaS Metrics, and we're doing this with Dave Kellogg today. Before we get started, I want to remind you that we're recording this session, so a link to the recording will be available, I think, tomorrow afternoon, and also throughout the session, we'd like to invite you to submit questions. So there's a Q&A tab, a Q&A button at the bottom of your screen. Please use this to submit your questions for Dave and myself. Don't use chat. Chats, we won't be looking at chat. That's amongst yourselves. So it is the Q&A button. And I'm pleased to have Dave join me today. Dave Kellogg is an advisor, director, consultant, angel investor, and blogger. So make sure you hit Kellblog, 2 L's, 2 G's. And he focuses on enterprise software startups. So perfect person for us to have today to talk to us. He's an EIR and an executive in residence at Balterton Capital and a principal of his own consulting company. And he's been the CEO of Host Analytics, MarkLogic. He was a GM at Salesforce, and he was the chief marketing officer at Business Objects. And he and I did battle at Business Objects way back when. Anyway, thank you for bringing your expertise today, Dave.
Yeah, thanks for having me, You Mon.
All right, so today it's going to be interesting. We're going to do a crash course, so basically go over common metrics. We're going to do an AMA, so ask us anything. And then we're going to have nerdy conversations on the many, many nuances of SaaS and CS metrics. Now, before we dive in, for the folks watching this webinar, Dave, I'm going to ask you a question. There is a weird phenomenon, and it happened when we were practicing, and that was we'll talk about a SaaS metric, we'll define a SaaS metric, and then we'll argue about the metric. And why is that? Why are people arguing about SaaS metrics?
Why do people argue about them? Just because there's so many different ways to calculate them, and they're so hard to interpret, and they're sometimes gamed, right? Because investors use them. You start peeling back the onions on SaaS metrics and you find a lot.
Yeah, and it is weird that there's so much nuance. You think it'd be very, very common. Everyone would agree on it. Well, we'll talk about that, right? But I think that's it, right? Everyone can look at the same metric and come to very different conclusions, even define them differently. So we'll try to define some common metrics that you will use, and you'll talk about if you're a SaaS company. We'll talk about benchmarks where we think people ought to be within all the metrics, and then we'll do a lot of discussions. All righty. So let's start with recurring revenue. Okay, so this would be ARR and MRR. You all should really know all this, and so recurring revenue is the total value of all your subscription dollars at the end of the period. So sometimes some of you will measure it monthly if you have a monthly subscription model. Others of you will measure it annually. So annually you'll take the annual dollars of what everyone's giving to you, and that's the sum total of that is your ARR. Any discussions on that, Dave? That's pretty straightforward, right?
Yeah, I have 2 comments. So one, I'm just watching the chat too. So they're looking for a cage fight here, You Mon. So we're going to have to, go wrestle this out. And the Q&A, we've gone from 0 to 60 before you even started because we're asking about how to calculate gross margin in pure play SaaS. But on this one, look, I think the trickiest question, and this is pretty easy, right? How big is your subscription base? And the only place I get uncomfortable is when people do monthly contracts and they annualize everything, or they do 6-month contracts. So to me, match the cadence of your real business, right? If you're 60% monthly contracts and 40% annual contracts, you should show MRR in my mind.
Right.
If you're showing ARR, I hope you have annual contracts. If you don't, I think it could raise eyebrows.
I think that's great. You're right. I mean, that definitely. I mean, there is a reason why you do one or the other, and I would say stick to it. And by the way, when you stick to it on all your metrics. For instance, logo retention rate, right? So the period, monthly or annual, if you're a monthly cadence or annual cadence, think about the period and matching that. So logo retention rate is the number of customers you had at the start of the period. That's your denominator. So maybe let's just say the start of the month. And then, of course, you divide it by the number of periods that stayed with you at the end of the period. So if you started, at the beginning of the month with 100 customers, and then you ended the month with 98 of those customers, your logo retention rate is 98%. The inverse of that is your churn rate. That's 2%. Now, I'm going to show you version 2. Dave actually prefers a different version of this, and this is logo retention rate version 2. I'm gonna call this Dave's version. Dave likes to only count those customers that are actually up for renewal. So let's say you have monthly contracts, but somebody's on a 6-month renewal. They don't count, unless they are up for renewal. Is that the right way to think about it, Dave?
Yeah, look, I think there's just two very different measures. I think they're both useful, to be clear. I call one just logo retention rate. I call this one ATR, available to renew. So I call this the ATR rate, because the difference between them is it has to do with your contract duration. As you said, I'll pick, say half on 1 year, half on 3 year. Well, that means in any given year, just pretend it's year 2. Only half the base is up. Yeah, it was 67. Only half the base is up for renewal. So it'll change your rate by a factor of 2 in that example. So it really does matter. Are we answering the question of the total base, how many people renewed in that year, or of the people who had a chance to not renew, how many renewed, right? And I think they're both valid measures, but they're very different. And as an operator, I mean, one of the things we'll talk about, because really the best answer to your first question to me is, why do people fight about this? I think investors and operators care about different metrics. And this is a good example, because if I'm trying to kind of financially value your installed base, I'd probably look at V1. Because part of your reality is the duration of your contracts, right? So like, okay, in any given year, what % of people choose not to renew? Okay, that's great to value the base. If I'm an operator and I'm trying to figure out how happy my customers are, I want to know of the people who had a chance to not renew, right? How many didn't? And there's different questions.
I think that's right. So let's go back to this V1. Basically, I would imagine most people, when you're talking to investors, other companies, you're going to swap this metric, right? As, hey, what's your retention rate? What's your logo retention rate? You'll use this. But internally, this is probably a more effective way to see if you're healthy or not. So
basically, yeah,
okay.
It's exactly right. That the investor, I mean, look, investors are trying to figure out whether to invest in you, and they're trying to figure out financial parameters. You're trying to figure out how to run a business, and those things aren't always the same. If you're trying to run a business, you want to look at this one. If you're trying to value the base, you want to look at the other one. Do you want to do questions in real time, You Mon? I see some stuff we could do now in the Q&A.
Yeah, go ahead. Yeah.
So first, we fire away. What's the rationale for keeping the cadence on MRR versus ARR? I personally think it's misleading. You just pretend you only sign monthly contracts and you show up and say our ARR is $12 million. I think you have a bunch of 1-year contracts because you said ARR, not MRR, right? To me, it's not as simple as ARR equals MRR times 12, right? I mean, that's true mathematically, but whether you pick to talk about MRR or ARR is really telling me about your contract duration, in my opinion.
No, so go ahead. Yeah,
go for it.
And there's another one in your version of logo retention rate. How will you treat customers on contracts that allow early opt-outs?
Yeah, your audio is going a little squirrely again. The
Okay.
answer to me is I would, personally, I would note in the footnotes, like, how we do business. Some people have opt-outs, but personally, they were not available to renew, right? The ability to escape is not the same thing as you were up for renewal. That's how I'd handle it. I would not count them because they're not up for renewal, but I would footnote it.
Okay.
Just trying to build trust.
Got it. And how am I sounding, Dave? Is my
Better.
microphone better? Okay, great. All right, let's go to gross revenue retention.
Yep.
All right, so gross revenue retention is how much recurring revenue do you have, MRR, ARR, right? At the start of the period, let's just say $10 million to make the math easy. And then with that same base of customers, that $10 million worth of customers, what happened at the end? Actually, right, which is where you subtract churn and subtract contractions, but do not include expansion. So basically everything except expansions, that's your gross revenue retention. Now, I've seen this calculated different ways, right? But this is a very common way of doing it. How do you feel, Dave, about doing gross revenue retention this way?
So I like this way of doing it. Mm-hmm. Look, I think the change of late is that people are getting a little more focused on gross, because as much as people care about net revenue retention, and we'll talk about that in a minute, and they care about net dollar expansion rate, there's a sign they have at French railroad crossings where it says "Un train peut en cacher un autre," and it means one train can hide another. And the idea is, hey, be careful, because if you see one train and it clears and you drive out, you get hit by a train in the other direction. And that's the way I feel about net expansion, which is you can find companies, if you just look at the net expansion rate, you go, wow, it's 125%. This is world class. Mm-hmm. And in reality, it's 45% expansion hiding 20% churn. And one train can hide another, right? So I think now, because companies have gotten so good at expansion, there's a lot of people hiding this churn. And if I'm in customer success, I do not want to hide that churn, right? But they hide the churn behind the expansion, and this prevents that from happening. And that's why this metric, in my mind, is kind of on the upswing.
So gross revenue retention really is your customers, and then you take out churn, you take out contractions, you do not include expansion. So let's go right to the next one, because they're definitely connected. Net revenue retention, which has seen a huge rise over the last few years. It's the same formula, except that you do expansions, right? So they're buying more users, they're buying more add-ons, they're buying more product from you. That's net revenue retention. A big deal is that gross revenue retention can never be over 100%. It could be at most 100%. And net revenue retention could be over 100%. And if you've been following the rise of NRR, net revenue retention, that a lot of folks, are really crowing about, very high NRR. Any thoughts about NRR? I mean, I know you think GR is good, but NRR is coming in strong, Dave, right?
Yeah, I think NRR is the hottest metric for expanding the valuing the install base. Mm-hmm. I think, what I think NRR is replacing is LTV to CAC. I can't remember if we talk about that later, but 10 years ago, if we said, let's try to figure out what your base is worth, we'd say, what's your LTV to CAC ratio, i.e. the lifetime value of a customer divided by the customer acquisition cost. Think of it as a balanced scale, right? How much is this customer worth versus how much we're paying for them? In theory, it's a good metric, but in practice, it's turned out to be gameable. There's too many ways of calculating it. And I think because of those problems, NRR is kind of come to the forefront to just say, wait a minute, because this is a cohort-based metric, right? Just take everyone who was a customer a year ago, how much were they worth? What are they worth today? Bang, that's your NRR. It's super simple, hard to game, very clear. So that's why I think this is a hot metric. And the metric it's actually replacing is not gross. People are looking at gross too for the two-train effect. But the metric that's on the downswing is, in my opinion, slightly controversially, LTV to CAC.
LTV to CAC. Well, I will say, I've been talking to a lot of people, in the CS industry, as well as a lot of other CEOs. And when they talk about raising money, right, and what investors are asking about, whether they're PE investors, VC investors, even public, even pension funds and whatnot, NRR is now a conversation that gets, it's a metric that is spoken about in the first 10 minutes. Right, of a conversation. It used to be, maybe it's the third meeting, right? When you and I were battling it out business objects, right? It'll be like the third meeting, doing due diligence. That's when they'll ask about retention. Now it's the first 5 to 10 minutes. Is that a fair assessment of the situation?
Yeah, I think the conversation literally goes, what's your ARR? How fast it's growing? Tell me your NRR. I think it's probably number 3.
That's right.
Can I rifle through some of the Q&A here real quick?
Yeah, go ahead.
difference between ACV and ARR? In my opinion, there's none. We'll hear from you, Mon, in a minute. But when I was at Salesforce, I think ACV included first-year services. I always found that bizarre. I think most people today use ACV, annual contract value, and annual recurring revenue. I think they're used as synonym. Does ATR mean the renewal date is happening in the period? Bingo, that's exactly what it means. It was available to renew, i.e. I could choose to or choose not to. And if I'm on a 2-year contract on my first anniversary, I am not available to renew, right? It's kind of a built-in renewal. It's even stronger than an auto renew, right? It's not even a renewal. I'm still in the contract. Can we define contraction? To me, is anything that makes ARR go down. You reduce your number of seats, you downgrade to a lower edition, you drop a product. And back to you, You Mon.
Yeah, okay. Then I'll do one from Alex. Alex asked, is NRR the same as NDR, net dollar retention? The answer is yes, except what if you're in the European Union? You don't say dollar, you would say, you use euros instead, pounds in the UK. So let's drop dollar retention, right? And let's use NRR because that's global.
Bad habit I have, especially since I work with a London-based firm. I get caught on that all the time. Yeah,
that's right. You were saying that during our practice. I had to tell you not to use NDR, right? Okay.
Yeah, NRR right. Is the correct
NRR
term.
Is the right one. So okay, but it's the same thing. Bottom line. Thanks for monitoring that. Let's go actually to the metric that you think is going away, or at least going down in stature, and that's lifetime value and CAC. Let's start with lifetime value. That's LTV, customer lifetime value. It's the average annual recurring revenue per customer times the lifetime. In other words, a typical customer, how much do you expect to get from them in revenue over the course of their life? So let's just say they give you $10,000 a year let's say they give you $1,000 a month. That's $12,000 a year. A typical customer will stay with you for 5 years, let's say, in your situation, and that's $60,000 over those 5 years. That is the lifetime value. I hate this metric, Dave. What do you think? Do you like it?
I don't like it. There's 2 reasons why I don't like it. One, I mean, you've defined how to get the lifetime, right? You're inverting logo churn, but right. A lot of people, there's 4 different churn rates. There's kind of ATR based, ARR based. There's gross and net, right? So you can think of a 2x2 matrix of churn rates, and a lot of people just pick the one they want to pick. And then that's the first problem, is too many ways to calculate it. The second problem is you could end up with a 50-year lifetime in a 5-year-old company, and it's just not credible. Right. As a math person, it means most of that value in the LTV is coming like after year 20, right? It's all heavily future loaded when you have these long lifetimes, and it's not credible. So I think, and then to get around that, people arbitrarily cap it. Like I've seen bankers literally type into a spreadsheet equals min 10, comma 1 over churn, right? So whenever the lifetime's more than 10, they just cap it at 10. And that's a big warning sign, right? When people are putting hacks into formulas. So there are some other problems with it, but yeah, I do not like this metric.
I think it just takes where you are right now and then extends it forever. Right. It's like, hey, I lost 1 pound today. I'm going to lose 1 pound forever. And awesome. Things just don't happen that way. Also, things do change, right? So let's say in year 2, you get 10 new competitors come in, right? It doesn't take into account changes in the ecosystem, whatnot. It doesn't take into account things like COVID or war, right? So I think it's rough, but it does get used. You ought to know it. If you're in the CS space, this will be talked about a lot. So it's good to know what it is. All right. The flip side of that is the customer acquisition cost. This one I think is actually a good one. And it's basically how much did it cost to get that customer, right? So generally what that means, once again, these metrics are not perfectly agreed upon, but how much did you spend on sales and marketing in the previous period? So that could be month, quarter, or year. Let's just say quarter, okay? Because that's how a lot of SaaS companies sort of do their expenses. So let's just say in Q1, I spent $1 million in sales and marketing. And in Q2, I brought in $1 million of new customers, right? So the CAC ratio would be 1, right? $1 million spent in Q1. Actually, no, then okay, see, that's a different ratio. See, I'm screwing this up, Dave.
Busted,
all right, Dave,
busted.
back to you. Back
Yeah.
to you. Go
So
ahead.
you just did what I always do, which is
That's
you
what I
can
always
calculate
do.
this as a cost per customer, which is
That's
what the
it.
formula on the slide says.
That's what it
So
says.
basically, if you spend $100,000 to get 50 customers, you're spending $2,000 per customer. So technically speaking, the CAC has units, and those units are dollars per customer. The CAC ratio, which you intuitively did, which I prefer, so I like where your gut went. Says, hey, let's make this a ratio and say how many dollars are spent on sales and marketing versus how many dollars of new ARR. Debate, is that net new ARR, i.e. offset by churn or not? We can come back to that. But to me, it's sales and marketing dollars divided by new ARR gives you the CAC ratio, which in English is how much in sales and marketing do we spend to get $1 of ARR? Now, to answer the question, I would have said, I prefer the dollar-based one. If you're going to do, I prefer the ratio where there's no units on it, right? If you're going to do the other one, the one on the slide, just make sure you don't have a bimodal business, because this works fine. If your average sales price is 10K and all your customers are normally distributed around 10K, you can just say, hey, it costs us 15K to get a customer. If you have a more complex distribution, because you have an inside model and an enterprise model and a mid-market model, then I tend to say do it in dollars, or present this, a cost in dollars, but segmented by business segment. Back to you.
Yeah. So, I mean, look, sorry for confusing everyone here. So I'm going to try to get this one right. So the cost is how much did you spend in dollars or euros, right? In cost to get a customer. So if you spend 1,000 euros to get a customer, and then the customer pays you 1,000 euros a year, there's the cost. There's also the ratio. So anyway, it's important. Basically, it says how efficient. Let's say what it means. It's how efficient have you been to acquire that customer? And most funders want you to be fairly efficient. They want you to spend money to get a customer, but if you spend too much to get a customer, that's no good. It's almost like I can get lots of customers if I give you $2. And to get $1, right? So there's bad ways to grow a business. All right, I think the last one before we get to questions and polls is the LTV to CAC ratio. This was a very, very, very popular ratio. I think it is fading in favor of NRR, like you said, Dave. But basically, when you take LTV over CAC, it kind of tells you, and that's a ratio, right? And I think people were saying 3 is good. So in other words, if you get 3 times as much lifetime value over how much it costs for you to get them, that's a good business. So that's the profitability. Is that fair, Dave?
Yeah. So look, while I have my quibbles with how this gets calculated and gamed, I love the spirit of LTV to CAC, which is, because a lot of times people say, well, a CAC ratio of 1, i.e. you're spending $1 to get $1 of ARR, is really good. And I'm like, yeah, if you're just benchmarking CAC, but if your churn is 40%, you're going to go out of business, right? Because your lifetime is 2.5 years. So, and conversely, like I ran a company where our CAC ratio was above 2, and investors would look at that and kind of go, oh, above 2 is too high. But I'm like, I have extremely sticky enterprise software with a 10-year lifetime. Right. So I think this ratio tries to say what you pay for something should be a function of what it's worth. Right. So if you're buying super sticky enterprise customers who aren't going to switch for 15 years, you should be kind of allowed to pay more for them than somebody who can get the lowest CAC ratio I ever saw was a guy who pays 40 cents. It's almost one I've seen firsthand. And he's paying 40 cents to get a customer. And if you can hold them for a long time, it's great. But if they're churning right off, then even a 40-cent CAC isn't great if you have super high churn. So I like the intent of this metric. It's still out there. People still ask about it. Back to the Q&A, I don't really view it as a top funnel metric for marketing and sales channels. I view it as I view it as really an install-based valuation metric, which is you're buying. Look, SaaS businesses buy customers. I would say your CAC ratio tells you how much it costs you to buy $1 worth of customer. So you're spending, let's say it's $1.50 to buy $1 worth of customer. Well, how much is that worth? Oh, it's worth $7.50. Oh, that's great. Your LTV to CAC is 5. That's a good deal. So that's the intent here.
All right. Well, hey, let's do a poll. And while we do the poll, I do have a question. While people are answering the poll, let's ask a question. Hey, as an individual contributor, what are good metrics to judge your work by? So we've talked about a lot of metrics, but if I'm a CSM doing work on a day-to-day basis, which metrics should I be focused on and which one should I avoid?
You want me to swing at that?
Yeah, please, Dave.
Yeah, it's really hard. So first, I would say my first answer, just as a kind of business finance oriented person, former CEO, is I like the notion where each CSM has their own NRR, basically, right? Each CSM is a microcosm of the company. So we're going to give you a cohort of customers worth 100 units. And if you can make them worth 115 units a year from now, power to you, that's awesome. If you make them worth 80 units a year from now, that's not so good, right? So I like to start there, but I often feel in Silicon Valley, we have diving competitions without degree of difficulty, right? So you go up and do a swan dive and get a 10. I go up and do a triple backflip, miss slightly and get a 7, and you win the competition, right? And I do think sometimes you put your best CSMs, you ask them to do the triple backflip, right? You give them some really hard to handle customers. Right. So I think you need to, if I were a CSM or a CSM manager, I would try to somehow weight or factor that in. I don't have a great math answer to it, but I don't want to disincent my best CSMs from taking the hardest accounts. And I don't want to reward the people who basically did layups. They got lucky and I handed them 10 super happy customers and now they're a hero, right? So, I would also look at, I call it post-case NPS or post-case CSAT on every interaction with the customer. How are they rating you? I would look at NPS, basically an annual NPS survey by buyer role. I also like to measure intent to renew. I think people try to use other things as a proxy for intent to renew. I just like to say, are you going to renew? Because you might be super happy and not want to renew, and super unhappy and be renewing, right? So I like to decouple those things. But anyway, long rant there. Back to you.
So I would say, okay, so I'm going to summarize. NPS, I think, you can get that kind of real time. It happens, fairly regularly. It's direct feedback. Intent to renew. Yeah, actually, I like that. I don't see a lot of people doing that, so maybe that's something we should try more. NRR is great, kind of a lagging indicator, of course, but in the end. Now, you said, hey, put degree of difficulty in there. I love that, but you just stated a problem without giving me a way to do that. So that's just that's tough, Dave. Like you're gonna have to.
Well, we're gonna
have to figure that. No, well, we're gonna have to figure a way to do that because I love that idea that a book of business not only has revenue attached, it also has difficulty attached, right?
Well, I know how to do it. Here's I've never give up on these things, as you know.
Go. Yes.
So I would, and this is gameable, but here's what I try to do. I would take each book of business and forecast what's going to happen to it, and then measure you off the forecast. Like just say we knew this customer had told us they're a $500,000 customer and they told us they're not renewing. So I'd say I'm handing you a $2 million book of business where I'm expecting to get only 1.5, right? I'm creating a very clear scenario. Yeah. You could imagine doing a forecast or some kind of forecast off the surveys. Ooh, now I'm getting goosebumps. Where you try and use the intent to renew survey to say, we think your book of business at renewal is worth this. Go beat that. Right. I'm just trying to get away from the first order obvious problem that if you hand me an angry customer worth 500K and I jump through hoops to save them and get the 500K, everyone goes, oh, you didn't get any expansion. It was like, wow, exactly. I just did a miracle. Right.
All right. That's a good first shot, Dave. Forecast, percentage of forecast that you bring in. It's actually probably as good as you get right now. All right. The poll is done. I think everyone can see it. Dave, can you see it? So basically, in order, what metrics does your company report to your board? ARR is number 1, 3/4. NRR is actually a strong number 2, with almost 60% of you reporting that up. And then gross retention, half of that, actually less than half of that. And then LTV and CAC kind of running behind. So yeah, pretty interesting. Not too surprising. Any surprises there, Dave?
CAC is a little lower than I would have thought. That's all, because CAC to me, and look, actually the one we didn't talk about was CAC payback period, which is kind of replacing CAC. Maybe that's we didn't ask about that one, but that's the only surprise there. I don't know if you want to talk about CAC payback period or not.
Let's go on to benchmarks. There's a lot of questions about benchmarks. So payback period is really important. Is actually another important one. Look it up, or we have time. Maybe we'll get back to it. All right. So I'm going to get rid of this. All right. So now let's talk about benchmarks. Everyone wants to know where they stand. I get it. I do too. So there are a lot of studies out there. One I actually like a lot is from KeyBank Capital Markets. You can, if you go search for them, they have a big old SaaS metrics report that you can download. Anyway, they do 350 SaaS companies, 2/3 in the US. This was conducted in 2021 based on 2020 numbers. So basically, this was during the first COVID year, 2020. This is what we're going to be focused on. So because it's a COVID year, things are probably suppressed a little bit, but at least you could, think about how you guys did in 2020 compared to these benchmarks. And who was the typical surveyee? About $8.5 million ARR, growing 31% year over year, 75 employees, 280 customers with an ACV of 28,000. Basically, these are unlike, what you hear about a lot of podcasts, a lot of videos. These are all of us, right? These are just all of us SaaS companies merged together, the high flyers, the low flyers, the mid flyers. So I think this is actually a really good number. All right. So now that I've said that, let's start with this, the summary view. And I'll go ahead and you can see on the left side, basically your typical typical SaaS company added about 25% of new bookings. Okay, that's the dark blue. Okay, and then they upsold another 15% on top of their ARR in upsells and expansions, and they lost about 13% in churn. And so their median growth rate was 28% year over year from 2019 to 2020. This is measured in ARR. So basically, they grew 28%, 25% new sales brought in, 15% of them was expansion and upsell, and then you lost -13. So you lost 13% in churn. And how does that feel? Does that feel like about right? Given you work with a lot of companies, Dave, does this seem like, how companies typically grow?
Yeah, I mean, I think to your point, it's including everyone. So including, the question is, if you're trying to be a high performer, just beating these numbers is not going to be enough. This is including everyone. So I think depending on your size, you want to be going closer to 50 or 100%, right? So I think the ratios are more in line. Like $1.20 for a blended CAC is pretty normal. Subscription gross margin 80%, pretty normal. Yeah. Sales and marketing as a percent of revenue is pretty normal. But the faster you're growing, the higher that number goes. Right. So in terms of the offset between expansion and churn, here they're only basically, you could assume they have 102% net dollar retention rate, right? 15 minus 13. Look, the median in my mind is around 102, 104. And again, that's the median. So if you want to sell your company for 10, 15 times revenues, you need to be a lot better than the median. Yes. I think 120 is world class. Snowflake was at 180. And, I think at some point the customers rebel, right? I don't like paying 1.8x compounded every year for a subscription to something, right? I better be getting a lot more value. So there are limits on how far you want this to go.
Well, let's talk about that because that's going to come up, right? All right. So logo churn, right? So basically, how many customers are you losing year over year? The median is you're losing 13.4% of your customers. Okay, that's the median. And so therefore you're keeping 86.6% of your customers. This feels right to me. Talking to folks, if you're enterprise, you should keep more. If you're SMB, you will keep less, right? Or you'll churn higher. Feels right to you, Dave?
Yeah, it does feel right. Look, I think the hardest part with this particular metric is little customers, particularly like PLG trials, right? I think PLG trials should be excluded from logo churn calculations personally, because I'm not sure they're customers. I would exclude them both from my customer count and my churn. Right, if I'm basically giving my product to lots and lots of people to say, try it, and then some of them buy it, to me, they start becoming a customer when they actually buy it and sign a contract. But certainly trials can throw this number way off. Otherwise, this looks about right to me.
Yeah. Well, let's and I think it's important. We have a lot of folks with different kinds of go-to-market strategies on the call here. We have folks who service big customers, little customers. So I'm going to ask. I'm going to say something. I want you to tell me if you agree. These 13 folks here who churn between 25 and 30% of their customers, right? 13 companies that churn between 25 and 30% of their customers. Am I freaking out about those? If I'm one of those 13, should I be freaking out, right? If you on the call, you want, fit into that bucket, should you be freaking out? I will say that it's on paper, it does not look great. Okay. But if your ability to get a customer, in fact, it costs you 40 cents to get a customer, something really low. If it doesn't cost you a whole lot to get a customer and you get a lot of customers coming in, so you have a high, lots of customers coming in, doesn't cost you a whole lot, and you're turning to most of them, you can probably get away with it, right? If you're spending a ton of money to get a customer, your enterprise sale, expensive sales reps, long sales cycle, that's a disaster. Is that fair, Dave?
Yeah, in general, look, if you're in that range, you should be concerned. I can think of, we can both contrive examples where it would be okay, right? So yours is, hey, you have a super low CAC, so you can justify with the super high churn. Okay. Another one is your pivoting strategies, right? So you had your old strategy, your new strategy, and those are old strategy customers churning off. Another one is their trials. Oh, they're all less than 3K in ARR, and our average deal is 20K. They were little trial people who we counted as customers, in which case the answer is stop counting them as customers, in my opinion. And then you can stop counting them as churn. But yeah, that's an alarming level of churn. You're going to have trouble raising money, put it this way, with that kind of churn rate.
All right, we have a lot of questions, but let's go to 2 more slides and we'll get to the questions. Okay, net revenue retention. Okay, so you said median about 102 to 104. That's what you see, which is we're almost exactly there. So 101.8 median. Basically net revenue retention. I think this is about right. So there's folks up here with 150% or more. All right, so let's do this again. If you are, let's say you're at the median. Did you sweat it, or should you be okay? I guess once again, I think this is it depends metric, right? And you and I were talking. If I'm Slack, or I'm, let's say Zoom, right? Those two had like enormous NRR. And, they should, right? Because those are land and expand types of products. And what I mean by that is that by nature, like almost by design, you sell a small piece up front, like one department, and then it's supposed to expand. Like it's supposed to expand. If it doesn't get 150% NRR, then it actually breaks the business model. Versus if you're SAP and you're selling like this big enterprise thing that you got to like buy, and then deploy all throughout the company all at once, like you just sold everything up front, right? And you're not going to get as high NRR. Fair enough, Dave? Is that right?
Yeah, I think so. Look, my belief to the first question you asked there was, to me, it's all about the words going with the music. What do I mean by that? That I view the numbers as the words and the music is the story you tell, and they have to go together. So if you're there telling me we've got this awesome land and expand model, we go in with a really low price, and then we have a dedicated expansion team that does these upsells, and I say, wow, what an amazing story. What's your NRR? And you go 95%. The words don't match the music, right? So to me, you're allowed to construct, you should have a narrative about what your business model is. I've worked with some companies that have a 0% expansion rate because they sell enterprise coverage on the first deal, and the only way they get increases through price increases, right? And as long as you explain that and just say, this is not a land and expand play, because we cover the whole enterprise on the first deal. And by the way, maybe it will be tomorrow. So today's business is we're going to land, cover everything, and we're working on a new product. So we think in the future we can get more expansion, right? But to me, it's just about making the numbers. I think the thing that most often goes wrong with SaaS metrics is when they're incoherent with the story. So no metric is inherently evil or good, but it has to match the story. So if you're going to tell a big land and expand story, and you've got multiple products and cross-sell and additions and price increases, or consumption-based, I better see a nice NRR. If you have none of those things, well, first I'm going to wonder why you chose that story. Like, why aren't you consumption-based in pricing? Why don't you have additions, right? But if you have great answers for all those questions, then I could say, okay, this is not a big expansion play, but you've got a low CAC, and your strategy to grow is to get more customers.
I would say also the other thing is if you are early in your company life cycle, right, and maybe you're year 2 and you're building out the core product, right, and there's not much to upsell because you're still really trying to beef up your core product, your NRR is going to be low, right? So until you
totally agree,
right? Yeah,
totally agree. Early in your history, the other metric we didn't talk about here, but I actually look at personally is expansion as a % of new ARR. And when you're early in your life cycle, I want most of your new ARR to be new customer ARR, not expansion ARR.
Right.
Like I don't care if that's low, because right now we're trying to get lots and lots of customers. I kind of assume we can, as long as you have a story, we can upsell them later. If you've got additions built in or consumption or a second product coming, right? So that's how I think about that.
Yeah, and by the way, I was looking at Salesforce's numbers. So Salesforce, the biggest SaaS company out there. I think 80% of their new revenue every year comes from existing customers. So that's they're flipped on. They're at the opposite of what a new customer.
Absolutely, and a great example of why not to benchmark against them if you're a little company, right? Because they've acquired billions of dollars worth of cross sell, right? I mean, at some point their strategy changed to, I've got this awesome sales force, I have these amazing customer relationships. Let's go build and or buy more products to go sell to people, right? That's the business they're in today.
All right, let's do CAC ratios. CAC ratios, once again, is how, a ratio. This is the ratio. Is it a ratio? Yeah, it is a ratio.
It's a ratio.
For every dollar that you got in revenue, how much did you spend to get them? And so, let's just say, for new customers, it says you spend $1.67 to get one new dollar of ARR. And then for expansion upside, you spend 63 cents to get that incremental dollar. This feels about right to me. Yeah.
Yeah, these numbers feel right. I mean, there's some people, I'm looking at the Q&A, and people are like, what's a good CAC? What's a bad CAC? And the answer here, for example, on a blended CAC is if you're $1.20, you're at the median, so half or better, half or worse. If you're at $1.54, that means only 25% of people spend more than you do. Is that inherently evil? No, but you better be able to prove to me, you better be able to explain why. For example, if you're growing really fast and hiring lots of salespeople that are unproductive, that's going to drive your CAC up. Or maybe you have an exceptional LTV or an exceptional NRR. Oh, yeah, you get to spend more money to acquire a customer because they're going to be worth more. Right. And by the way, conversely, you can see this expansion CAC here at 63 cents. If you don't have a great expand story, but just say your new customer CAC is 63 cents, the argument would be, I can get new customers for the price people get existing customers.
That's you go.
That's a great story. Yeah.
Yeah. I do want to talk to the person who spends 40 cents your story to get a new customer. I love to hear that story. All right. So there's a lot of questions. So let's actually go to the Q&A side. And so I think I'm going to stop sharing. Actually, let's go ahead and dig in. All right. So digging in, let's go ahead and ask questions. Hunter asked, I love this question. I have it as a question as my own. You're a brand new SaaS company. You just started, Dave. You're not going to focus on all these metrics. What 2 or 3 metrics would you recommend that a customer success team track to start? You're pretty new.
I would do ATR-based renewal rate. So if 100 customers have the chance to renew, how many renew? I would do NPS. And NPS is, Net Promoter Score. The most thing people get wrong on that is they kind of think of it as one per customer. And the issue is, like, the last company I ran, we sold to the VP of Financial Planning and Analysis, but the users of the software were every manager in the company who had a budget. And so they're very different roles, right? And so the person writing the check, I mean, ultimately, I care if they're happy. But let's just say it's not going to be sustainable if they love us, but all the end users hate us. Over time, he or she is going to be under pressure to switch the system. So I think NPS, where people could get lost, is they fail to look sufficiently at different buyer roles. The other question in the Q&A is, how do you do an intent to renew survey? To me, it's really simple. Right after you ask the NPS question, which is, would you recommend this software to a friend or colleague, 0 to 10, you say, do you intend to renew the contract this year? Or do you intend to renew the contract when it comes up for renewal? And you just, boom, ask the same question right there. And look, they do correlate. So most people, those two numbers won't be that far apart. But to me, the interesting ones are where they are really far apart. So I'm super happy, but not renewing. Holy cow, get on the phone. What happened? Oh, we're getting acquired. And they say we have to use the other system. Well, wait a minute. You're so happy. Maybe we can switch them to our system. Can we get a meeting with the boss? Right? Instead of taking their system, maybe we can move them over because maybe they're not happy with theirs. Right? And the really interesting ones are where there's a gap.
I would also say the intent to renew. I think that's a powerful question. Make sure you only ask those of people who have the ability to renew. So not the rank and file, right? So they have no ability to answer that. All right, let's see. I would add one more metric to that. If you're a brand new startup, that is some kind of activation rate. Like, are they, are you getting them to, are they onboarded correctly? Some version of that, depending on the type of product or service that you're selling. Somebody's asking about time to value, Dave. We haven't talked about time to value. You do hear about this a lot. A lot of CEOs, mention those three words, time to value. I'm a little skeptical. I mean, this one feels really soft to me. So any thoughts on time to value, Dave?
Yeah, this might be slightly outdated, but back in the days when people used to call their adoption people implementation consultants, that I don't know if it still is a popular title, but like that was a job. Like, I help people get implemented to get up and running with our software. We used to define it as how long till you were implemented. And for example, I did a consulting project for a higher ed CRM company. And basically the question is, do you want to measure how long it is until you can log into the software, or how long it is until you've run your first marketing campaign? And in my mind, that's what I like to measure. Right? I think it's a mistake. And actually, this is why I don't recommend calling them implementation consultants, because it says right on my business card, hey, my job is done when you're implemented. Good luck, fare thee well. And I like it when, no, my job is to have you run your first campaign. I'm not done until you've run because you bought this software to run campaigns. True? Yes. Okay. So we're going to say you're getting value when you've run your first campaign. So I would measure that and focus consulting or implementation teams on that. So that's a distinction I think is super important. It's related to time to value, but not exactly.
I think that's right. All right. We also been throwing out a lot of terms, a lot of terminology. Someone asks, what's the difference between upsell and expansion?
Upsell. Yeah, I mean, I can do this one if you want.
Yep.
So, and this is just a Daveism. I don't think this is industry standard, but my definitions are: expansion is anything that makes ARR go up, and shrinkage is anything that makes ARR go down. Expansions could take multiple forms: price increases, addition upgrades, cross-selling new products. So to me, I try to use expansion and shrinkage as the generic terms. Just like on the downside side, I say churn is anything, or shrinkage is anything that makes ARR go down. That could be downsell, right? Like I went from edition gold to edition silver. It could be lost seats. It could be I had to give you a discount to renew. Right. So that's how I do it, but that's all very.
So that's expansion. Do you think upsell is different? Like if someone says upsell,
I think upsell is a type of expansion. I view upsell as I move you from edition 1 to edition 2.
Okay.
I view cross-sell as you bought product 1 and I sold you product 2.
So upsell is specifically like you are moving up within the same thing that you bought. Right.
I'm not always rigorous about it. When I'm writing a blog article, I try to be disciplined. When we're speaking, most people use expansion and upsell as synonyms.
Okay. All right. So there's a new there's something new in town, right? There's been SaaS now. Now the hot new idea is consumption, right? Consumption modeling. So there are folks out there, right, where you really don't have a contract per se, right? Is someone's your customer? If they use it, you charge them. If they don't use it, you don't charge them. Let's say Slack. Actually, Slack kind of does like if you don't actually use Slack for a month, like if your whole company stopped using Slack for a month, I don't think they're going to charge you. I think that's sort of what they're saying. Anyway, it's fully consumption model. How does that change what metrics you would use to run the business, Dave?
So look, I'm going to be slightly jaded on this one, because when you're doing enterprise consumption, enterprise salespeople are really good at one thing: making sure it never goes down. So I'm going to sell you a bunch of units or points for a year, and depending on how you burn through them, it might affect my revenue recognition. It might, but in effect, if you don't use them, I don't actually get less ARR than some baseline. There is some baseline committed amount. I'm basically using them as kind of overage minutes. I'm slightly jaded on this perspective, but the more you're talking true enterprise, the more I'm sure this is the way it works, because I know how enterprise salespeople work, and they want zero risk of going down. So they're all talking about your future growth and how can you get a better deal on your future growth. That tends to be the spirit of the contract. The contracts tend to be floored. So I think consumption. Now that said, in a consumption model, there is a strong incentive to get them to use those points, even if from a technical perspective, I won't get churn off it. What I want is expansion. So it does mean I want to monitor usage, right? Just like I said in the SaaS model, I want to carry you to your first campaign before I declare victory, not implementation. Here, I need to be ongoingly monitoring your utilization and basically calling you and asking you why you're not using more units. Like, what's up with you making less API calls this month? What's changing? What can we do about that? So I think it does monitor. Because look, the classical SaaS CSM just wants you to renew your contract, and if it goes up 5 or 10%, hallelujah. That's good enough. Victory is declared. In a consumption model, it's harder because I need to make sure you're using the stuff and using more of it, right? So and that's harder. So I think it does change the operational metrics for the CS department.
So Dave, we barfed out a lot of metrics for people in this last 50 minutes. Maybe we can simplify. Okay. And maybe I'll start from bottoms up. Let's say, I have a CS team. I need them focused. It's a mature CS team, not a new CS team. What should I have them? Which metric should I have them focused on, right? This is let's say I'm a $20 million ARR company, mature team doing well. Which metrics would you have them focused on?
Look, this all depends on the sales model, right? I mean, this is to a certain extent, I can't answer the question because who is responsible for the expansion in the account? And that's all over the place, right? At some companies, there's a brick wall between sales, and sales gets new customers, throws them over a fence. CS gets them, and CS's job is to renew them and expand them. In some models, the one we talked about yesterday, there is no CS. It's just all sales, and sales owns responsibility for expansion and renewal. That's kind of the old school model. I personally like a hybrid model where sales is responsible for bringing them in, but both sides get credit on expansion. Sales' primary job is new customer acquisition. CS's primary, I would say new ARR acquisition, sorry. CS's primary job is expansion and renewal, but I want them to be able to team. Here's why. What I call a resell. Yeah, I'm pretty happy with your system, but we got a new CFO. We're going to do a bake-off. So in a brick wall model, I'm going to put people may not like this metaphor, my farmer against the other guy's hunters. Because if there's a bake-off happening, there's going to be a hardcore, crazy enterprise sales rep from competitor 1 and competitor 2. And if I have a real brick wall, I'm going to put a CSM against them. Much as I love CSMs, they're probably going to lose that battle, right? I want to put my hunter against their hunter. So I either need a shared model where the CSM can go, ruh-roh, we've got a problem. There's a bake-off here. I need the salesperson to be able to help me. And normally that renewal will be excluded from their comp plan, but I would actually say to sales, if we've established that it clearly is a resale, I'll pay sales again to go win it because they're doing the exact same thing they did to win it the first time. And conversely, which is if there's an expansion that doesn't look super hard, happy customer, it's another VP in a different division buying 50K more of a 50K deal, let the salesperson pass it to the CSM, right? So the salesperson could be doing what they do best, right? Which is really out fighting for new business. And sometimes existing business looks more like new. And the CSM is doing what they do best, which is making customers successful and happy. So I love personally the hybrid model. It doesn't work in all cases.
So Dave, the way you I love that. That sounds great. That sounds like sales and CSM working really well together, right? With good rules of engagement, good handoff processes, and shared metrics. Sounds like Nirvana. Okay. Have you seen it? This follow-up question. Have you seen it work?
Yeah, I have.
All right.
Nice. And it doesn't even cost that much, to be honest, because people are like, you're double comping CS and sales on the expansion. But CS people, frankly, have usually much bigger numbers than salespeople, right? A typical sales quote is $1 million in ARR. A typical renewals quote is like $3 to $4 million. So the high quota tends to drive the rate down. So it's actually not that expensive to pay both sides on expansion.
All right. Well, let's end with this question, Dave, and we'll actually end at the highest level, and that is, and we ask this question to everyone. But what do you think boards and investors care about? Like in the end, if your company's healthy, perceived as healthy, gets valued in the IPO market or by acquirer, or you're making money, what are the most important metrics of all the ones we've talked about?
Yeah. Obviously for a company, it's ARR growth. We didn't really talk about it, but subscription gross margin, which plays into CAC payback period. right? CAC payback period is how many months of subscription gross profit does it take to pay back your customer acquisition cost. Investors look at that metric a lot. And all they're trying to do, all these metrics are trying to do is figure out, what you're paying for something, is it in line with what it's worth? And that's it. And up till now, frankly, growth has been king. I have to mention it, rule of 40 is the basic way they look at balancing growth and profit. They basically add your ARR growth or your revenue growth to your free cash flow margin or your operating margin to get a number. And the closer that number is to 40, as moving up, the more they like it. Above 40 is even better. That's why they call it the rule of 40, because 40 is considered a good score. So I think, given the way the markets are trending, that we're going to go back to a world where it matters, which is why I raised it. Because I think for the heyday of the last 2 years, it was all grow, go, 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 grow at all costs. Now it's going to be back to the more rational, hey, you're growing, but how much cash are you burning to grow?
Right. So therefore, the CS metrics would be even more important, right? Basically, are you keeping your customers, making them happy, renewing them? That has positive impacts on LTV.
Absolutely, because CS is going to obviously keep the base where, they're going to help the NRR rate ultimately, right? And they're going to help the expansion CAC. Which, to answer can I sneak 2 answers in the Q&A that I saw?
Yeah, you bet.
One, it's really hard to separate the marketing costs for expansion. I'm not a huge fan of expansion CAC. I like the concept, but most of the time they're doing some arbitrary. First, if sales is involved on both sides, it's hard to allocate sales to. It works best in the brick wall model where sales gets new and CS does expansion. The more hybridized the model, the less good a metric is on the sales side. And the marketing side, it's virtually impossible to split them. So people tend to take a random allocation. So as with many of these metrics, I'm like, cool. I like what it's trying to measure, but when you get into the detail, it's like, it's not really a perfect measure of it. The last one I wanted to sneak in was the person just saying, how do you take an on-prem company and show them the value of customer success? Because I think it's a super interesting question. I think it's really hard. I think the answer is you just got to talk about renewals, because in on-prem, there was no renewal, right? You basically had maintenance renewal clerks, right? That they were not account managers. They were clerks. Like your renewal, my joke was your renewal is being handled by legal. That's right. So, and in the SaaS model, you got to renew the entire ARR base basically every year. So this requires account managers, and you can have the salespeople do it, which is what the on-prem people are going to say. But then the question is, who's going to go sell stuff? Right. And that to me is kind of the first principles derivation of CS. And I think it can be positioned in their mind as somebody needs to get these renewals and somebody needs to team with sales to figure out how much energy is going to expansion versus new. Back to you.
Yeah, I mean, on-prem look, in the end, the business is the same. You got a customer and you want to keep them, right? And the metrics are maybe a little bit different, but really conceptually it's the same. Well, hey, we did metrics 101, 201, 301. I think maybe we touched on 401. So we did a lot of great metrics here today. Dave, thank you. And those of you in the audience, there were many of you and lots of fantastic questions. We'll try to hit some of them in the FAQ. And just as a reminder, we will have a recording of this. So both Dave and I speak quickly, so you can go ahead and play it at 0.8 speed and try to understand what we're saying. Anyway, thank you. And everyone have a great rest of your day. And we'll talk to you everyone soon.
Hey, you Mon?
Bye, everyone. Yes, Dave.
Hey, can I just answer questions in the Q&A by typing? Will the webinar still be alive if I do that, even when we shut off the video, or we'll do that later?
You know what we can do, Dave? If you want to do that, we have a Friday blog where we can publish that for perpetuity.
Fair enough. Okay. I'll grab these then. Well, thanks very much.
Okay. All right. Thanks, Dave.
Take care.